Welcome to World Revolution Channel. Today we present Book Summary, The Psychology of Stock Market Investing by Hyun Kim. It explains the psychology behind investing, highlighting how emotions and cognitive biases often lead even the most skilled investors to make mistakes. Famous case studies like Theranos and Bill Ackman's strategies illustrate phenomena such as self-deception, fixation on recent events, and excessive fear of loss. The book emphasizes that behavioral discipline is more important than intellectual intelligence in building long-term wealth, creating a system that protects against human brain biases. Let's listen.
And that's really heart of it, isn't it? That central conflict. Today we're doing a deep dive into Hyun Kim's book, The Psychology of Stock Market Investing.
Okay, let's really unpack this because it completely flips the script on how most people even think about finance.
It really does.
The core idea, which I find just so profoundly true, is that our entire approach to financial education is kind of misdirected.
Massively. We spend all our time on the formulas, the frameworks.
Exactly. The discounted cash flows, the PE ratios, all the technical stuff.
Yeah.
And we completely ignore the 90% of the game that is purely psychological.
It's the ultimate mismatch. Kim's argument is that our brain, it's an ancient survival machine.
Yeah. Built for the savannah, not Wall Street.
Precisely. It's wired for that instant fight or flight response, which is fantastic if you're, running from a predator.
But absolutely disastrous when you're staring at a balance sheet or a sea of red on your screen.
That quick, emotional, instinctive reaction is the very thing you need to suppress to succeed long term.
So our mission for this deep dive is to break down the first 6 of these major psychological traps, these glitches in our thinking that just sabotage investor decisions.
So we're not just going to name them. We're going to use some incredible, almost unbelievable case studies to show how these traps brought down some of the biggest and, frankly, brightest minds in finance.
Because the core takeaway, and we'll keep coming back to this, is that behavioral discipline is the real edge.
It's everything. The ability to stay rational when everyone else is either panicking or, completely euphoric, that's way more important than raw IQ.
That sets the perfect stage for our first segment. Let's dive right into what happens when that sheer intellectual brilliance actually creates the blind spots that lead to ruin. We're calling this one When Brilliance Blinds Us.
And there is just no better or more tragic illustration of this than the story of Elizabeth Holmes and Theranos.
It's an incredible story. For a moment there, she seemed completely untouchable.
She really did.
Think back to, September 2015? You have Holmes, just 31 years old, in that signature black turtleneck.
The Steve Jobs look.
Exactly. And she's promising a full-on healthcare revolution. The idea itself was so compelling.
Oh, it was genius. Hundreds of diagnostic tests from a single tiny drop of blood using her nanotainer tech.
She had the vision, the pitch, the whole spectacle was perfect.
And the money just poured in. The numbers reflected that hype. She raised, nearly $1.3 billion.
And Forbes was hailing her as America's youngest self-made female billionaire. The narrative was just flawless. Disruption, genius, saving lives, ending the fear of needles.
But here's where the psychological breakdown really begins, because as we all know now, the technology didn't work.
At all. It was a complete fiction. The sources are clear. Behind that veneer, they were manipulating results using standard third-party machines.
Right. John Carreyrou at the Wall Street Journal eventually exposed the whole thing. So if her genius wasn't technical, what was it?
It was psychological, pure and simple. She was a master at exploiting these universal glitches in our mental software.
She understood that if you build the perfect story, the perfect social ecosystem around an idea, people stop asking the hard questions.
She didn't have to build a better machine. She just had to build a better story and then back it with unassailable authority.
Which brings us right to that first huge trap she laid. The illusion of authority and social proof.
I mean, when you look at the Theranos board of directors, it was just stunningly prestigious.
It wasn't a corporate board. It was like a shadow government. You had former senators, secretaries of state, military generals.
Titans of diplomacy. And that was the fatal design flaw, wasn't it?
It was. The board gave her instant, massive legitimacy. It created this impenetrable halo effect.
But the crucial part is that it lacked any relevant technical or medical expertise. Not a single person on that board could actually vet the science.
And the average investor, even sophisticated ones, they looked at that board and thought, well, if George Shultz and Henry Kissinger are in, the due diligence must be done.
They just outsourced their critical thinking.
Completely. And the most heartbreaking example of this is George Shultz himself, a titan of diplomacy, a really Smart guy.
But the sources show he completely ignored warnings from his own grandson, who was a whistleblower.
He did. Why? Because the psychological commitment to Holmes was so strong. His own authority was tied to the venture. It created this immense cognitive dissonance.
It was easier for him to believe his own grandson was wrong than to admit that this entire edifice he'd endorsed was a sham.
And then that effect gets supercharged by the social proof from the investors. It's a feedback loop.
Right. When Rupert Murdoch, Larry Ellison, the Walton family, when they pour in billions.
The herd mentality takes over. The internal logic for the next investor becomes, well, if these masters of the universe are all in, who am I to question it?
It's that classic warning from the book. Just because everyone is jumping off the cliff does not mean there's water below.
When the crowd moves that fast, your own skepticism just gets shut down.
And that leads directly to the next trap, which is what Kim calls the smart trap.
This is such a fascinating paradox. The idea that high achievement can actually make you more vulnerable.
How so?
Well, success builds confidence, which is good. But over time, that confidence can quietly morph into ego, and you don't even realize it's happening.
And ego makes you fragile.
Exactly. The smarter you are, the better you are at building complex justifications for your beliefs.
So once a successful person, whether it's a hedge fund manager or an Ivy League, quant believes in a stock,
They stop defending just the idea. They start defending their own identity, their status as an expert.
a bad investment becomes a personal attack.
It's a pure self-defense mechanism. For a brilliant person, admitting you made a simple, dumb psychological error is often harder than clinging to a complex, losing thesis.
And we have to talk about the price of mental blindness here. I mean, the monetary cost is obvious.
Right. Theranos investors lost nearly $700 million. That's capital that just evaporated into hype. It could have funded real innovation.
But the more insidious loss, the one the book really hammers home, is the opportunity cost.
That's the killer. If that $700 million had just gone into a simple index fund, what would it be worth in 20 or 30 years?
The compounding you miss out on, you can never get that back. One early, psychologically driven mistake can literally change the entire trajectory of your wealth.
Which is why just being aware of these biases isn't enough. You can't outthink your own wiring.
So the solution has to be systemic. The book calls it thinking with guardrails.
Yes. So what does that actually look like for you, the listener? What are these guardrails?
They're pre-commitment rules. Simple rules you make in a calm, rational state to protect you from your future emotional self.
So, for example, a guardrail could be a non-negotiable rule like, I will never let a single stock become more than 5% of my portfolio.
Or, I will automatically sell if a stock drops 20% below what I paid for it, period, regardless of how much I love the story.
It takes the emotion out of the decision. You make the rational choice before the market starts to panic.
You're basically building a financial version of an airplane pilot's checklist.
Exactly. The pilot might be a genius, but they still follow the checklist every single time, because human error, especially under pressure, is inevitable.
The success of Theranos was a psychological triumph, but its failure was a structural indictment of relying on ego instead of process.
And that sets us up perfectly for our next case, which is about what happens when the most credentialed, mathematically gifted people on Earth become absolutely certain they've eliminated risk.
Let's talk about the danger of confidence that outpaces competence.
If you were trying to assemble a financial dream team in the 1990s, you'd end up with long-term capital management, LTCM.
They were the absolute apex predators of finance, the undisputed high priests.
I mean, look at the roster. Founded by 2 Nobel Prize winners in economics, Myron Scholes and Robert Merton,
The guys who literally wrote the book on options pricing.
along with Wall Street legends like John Meriwether. Their reputation when they launched in '94 was so stellar, they were actually turning away billion-dollar investments.
And the initial results just seemed to prove their genius. The first 2 years were just staggering.
Returns of 42.8% and 40.8% after fees. They built this mythology around their intellectual superiority.
So what was their strategy? It was complex, but the core idea was, on paper, beautiful.
It was. They used these incredibly sophisticated mathematical formulas and huge historical data sets to find tiny, supposedly risk-free price differences between highly correlated bonds all over the world.
So classic arbitrage. Buy the cheap one, sell the expensive one, and wait for the prices to meet in the middle.
Exactly. They saw themselves as just picking up nickels in front of a steamroller. Small, frequent, and what they believed were near certain gains.
But that perception of certainty, that belief that the math was infallible, that led to their catastrophic flaw.
Extreme system destabilizing leverage.
Why so much leverage?
Because they believed their trades were statistically uncorrelated, meaning if one trade went bad, the others wouldn't be affected.
So they felt safe.
They felt invincible. They cranked up the leverage to astronomical levels, eventually reaching a 25-to-1 ratio. By 1998, they had over $1 trillion in positions.
$1 trillion?
Their models accounted for all the normal market ups and downs, but they fundamentally ignored what's called tail risk.
Okay, let's pause on that. For the listener, what exactly is tail risk? What did their Nobel-winning math completely miss?
They assumed the market behaved according to a normal distribution, that classic bell curve. Extreme events, the tails of the curve, were seen as incredibly rare.
Like a once-in-a-thousand-years event.
Exactly. But what they missed is that in a real panic, correlations snap. Everything that's supposed to be independent suddenly moves together because everyone is running for the same tiny exit door at the same time.
And that's exactly what happened in August 1998 when Russia defaulted on its debt.
It was a political shock, not a financial variable in their models. And it triggered the impossible.
The market just seized up.
And their tiny price differences, instead of closing, blew wide open. And when you're leveraged 25-to-1, that's instantly lethal.
They lost $4.6 billion in 4 weeks. Wiped out.
And the fund was so huge that its failure threatened to take down the whole global banking system, forcing the Fed to step in and coordinate a bailout.
It's just a staggering level of arrogance built on math. Warren Buffett's analysis of it is so perfect.
It's the best. To make money they didn't have and didn't need, they risked what they did have and did need.
And that whole decision-making process just flows directly from the illusion of control.
It's such a common bias. We all have this tendency to believe we have more influence over outcomes than we really do, especially in a system as complex as the global market.
Right. We think we're steering the ship, but we're really just, at best, riding a massive, unpredictable tide.
And even the sharpest investors fall for this. Look at Stanley Druckenmiller, a true investing legend.
During the dot-com bubble in the late 90s, he knew rationally it was a bubble.
He absolutely knew. But what did he do?
He piled in anyway.
He thought he could ride the wave a bit longer and get out just before the crash. He believed his skill was so superior, he could time the exit perfectly.
He thought he was in the 7th inning when the game was already in the 9th.
And it cost him a $3 billion loss in 6 weeks. The illusion of control made him overstay a party he knew was dangerous.
Which brings up this strange paradox, why experts make more mistakes. It's like a high-end Dunning-Kruger effect.
You'd think experience would protect you, but often that very experience creates mental shortcuts that work perfectly until they don't.
And when they fail spectacularly.
Because expertise builds confidence, and confidence encourages you to take bigger and bigger positions. Look at the energy analyst example from the early 2000s.
Right. He had 30 years of deep industry knowledge.
And he confidently predicted oil would climb slowly and steadily from around $30 a barrel to $50.
Yeah.
His deep historical knowledge made him certain about the rate of change.
And what did he miss?
He missed the chaos, the volatility. He was so blinded by his confidence in a slow, steady trend that he missed the geopolitical tensions that would rocket oil to $147 before it crashed. He got the direction right, but the scale and timing disastrously wrong.
So the solution, according to the book, is to embrace what Howard Marks calls second-level thinking.
Which is really about humility. It's about going beyond the surface logic, questioning your own assumptions, and remembering that even the smartest analysis is still just a guess about the future.
And this all gets fueled by an internal mechanism, a really sneaky one, self-attribution bias.
This is that psychological distortion where when things go right, we say, that was my skill, my genius.
And when things go wrong,
oh, that was bad luck. It was the Fed. It was a black swan event. We take credit for the wins and blame outside forces for the losses.
it's a self-reinforcing echo chamber of our own brilliance.
It really is. Every win just proves you're a genius, building your confidence on what might be very shaky ground. You mistake a bull market, housing boom, for your own personal investing talent.
Until the crash comes and reveals just how much of it was the market doing all the heavy lifting for you.
So how do you protect yourself against this? How do you install a guardrail?
The book really emphasizes the power of an investing journal. It sounds simple, but it's incredibly high impact.
Before you buy or sell anything, you have to write it down. your thesis, your expected outcome, and, crucially, your confidence level on a scale of 1 to 10.
And the real power comes from going back and reading it later, after you know the outcome.
Exactly. It forces you to confront the evidence without the distortion of hindsight. Did you really get it right because you were smart, or did you just get lucky? Was your thesis actually flawed from the start?
It's the only way to identify your true patterns and keep your ego in check.
And that idea of separating true skill from just plain luck is so central to avoiding ruin that we really need to explore it on its own.
Okay, let's shift our focus to just that. Luck mistaken for skill.
And when you talk about legends whose skill was perfectly intertwined with luck and timing, you have to talk about Bill Miller.
Oh, absolutely. For 15 straight years, he beat the S&P 500 as manager of the Legg Mason Value Trust. He was treated like a financial prophet.
He had this reputation for, all-weather brilliance, a strategy that could win in any market.
But in reality, his strategy was very specific. He made these big, concentrated bets in deep value stocks, often in financials.
And that approach was absolutely perfect for the 1990s and early 2000s, when the credit cycle was expanding and the market was rewarding exactly that style.
But the environment changed.
Radically. When the 2008 financial crisis hit, his fund got absolutely hammered. It fell 55%, trailing the market by 18 points.
His strategy hadn't changed, but the world had.
And the streak was just obliterated. It proved that what looked like sustained genius was actually a brilliant strategy that was perfectly suited for a specific and temporary set of economic conditions.
This just highlights the need to understand the skill-luck spectrum in investing.
It's one of those really frustrating fields where a good process doesn't always guarantee a good outcome, at least not in the short term.
Well, if you picture the spectrum, what's at the extreme luck end?
That's where results are almost entirely random. Things like day trading, trying to time market tops and bottoms.
Yeah, good luck with that.
Right. It's a hugely competitive space with massive transaction costs. The house always wins.
And in the middle?
In the middle, you have things like stock picking over a few months or sector rotation. You need skill, but your outcome is still heavily dependent on outside factors. A Fed announcement, a geopolitical shock.
And then there's the skill end, the stuff that actually builds wealth.
Yeah, and it's the unsexy stuff. It's long-term strategic asset allocation, keeping your costs low, controlling your emotions, and sticking to a disciplined process.
Those are the things you can actually control.
Exactly. And they deliver results over decades, no matter what the market is doing this week or this month.
The problem, of course, is that outcomes are loud. They hit your brokerage account in real time, and they fuel your emotions.
While the process, the boring, consistent work, is quiet and slow. And that imbalance makes us focus on the flashy results and forget to ask if our thinking was even rational to begin with.
This outcome bias is perfectly captured in those huge studies on active traders, this so-called day trader's delusion.
Yeah, the research by Barber and Odine is just devastating. They tracked millions of trades over 15 years.
And what did they find about all those confident day traders?
That, on average, they lost money every single year. Nearly 80% of them lost money, and persistent success was statistically non-existent.
And the most active traders, the ones who are most confident in their own skill.
They did the worst. They underperformed the market by about 6.5% annually, even before you factor in their costs.
That is just staggering. The illusion of skill breeds overconfidence, which leads to more trading, which just burns through your capital faster.
It's the slot machine effect.
Yeah.
You only ever hear about the one guy who hit the jackpot. And that one random success is enough to keep everyone else pulling the lever, thinking they're next.
And we see a version of this same delusion applied to corporations in what the book calls the CEO celebrity trap.
We have this tendency to give all the credit for a company's success to the person at the top, the visionary leader.
And we ignore favorable timing, industry trends, or just dumb luck.
Take Hubert Joly at Best Buy. He was praised as a retail mastermind for that turnaround after 2012.
And he did a great job.
He did. But his success was massively helped by the fact that his main competitors, Circuit City and Radio Shack, both went bankrupt.
Right. That cleared the field for him. It gave him breathing room. The narrative gave him 100% of the credit for a success that was probably 50% environmental.
And the pandemic stocks are the most perfect recent example of this.
Oh, absolutely. The CEOs of Zoom, Peloton, Teladoc, they were hailed as visionaries in 2020.
But their explosive growth was totally circumstantial, fueled by a temporary lockdown economy. When our behavior went back to normal, their growth just evaporated.
It's the extrapolation bias in action. We see this amazing recent growth and assume it will continue forever.
And we overpay for the company because we're buying the charismatic leader's story instead of the underlying business fundamentals.
Which brings us back to the expert problem. In fields like, say, surgery or flying a plane, more experience reliably translates to more expertise.
Right. More hours, fewer mistakes. It's a clear relationship.
But investing is different.
It's totally different. The markets are mostly efficient, and luck plays such a huge role that consistent market-beating performance is incredibly difficult. Experience is vital for managing risk and your emotions, for sure.
But it doesn't give you a crystal ball to predict short-term market moves.
Not at all. The most enduring edge is just recognizing how little control you have over outside events and doubling down on what you can control.
Your process, your risk management, your own behavior. The intelligent investor accepts the role of randomness.
It's about being comfortable with being boring. You have to stop trying to be clever in the areas of the market that are dominated by luck.
But that desire to feel clever, to feel in control, is often what leads to the most painful bias of all.
The inability to admit that you're wrong.
Let's move on to seeing only what you want to believe.
And there's no better case study for this than the colossal failure of Bill Ackman and his almost $4 billion loss on Valeant Pharmaceuticals.
Now, Ackman is a brilliant guy, a rigorous, detail-oriented hedge fund manager, but even he fell right into this trap.
So in 2015, Valeant was a market darling. The stock had gone up over 1,000%. Their model was basically to acquire smaller drug companies and then aggressively hike the prices of their drugs.
And Ackman bought in heavily. He took a massive stake and even called Valeant a very early-stage Berkshire Hathaway. He bought the story hook, line, and sinker.
But then the red flags started popping up. The controversial Philidor pharmacy, the political scrutiny over the price hikes, whispers of aggressive accounting.
And the stock started to slide as short sellers began to circle.
And here's the core psychological failure. Ackman didn't reassess. He didn't question his thesis. He dismissed the critics.
He doubled down.
He publicly defended the company, and crucially, he bought more stock as it was falling. He confused stubbornness with strength.
He was trapped inside his own $4 billion echo chamber.
And the fallout was just devastating. Valeant collapsed 97%, and Ackman finally capitulated, taking a loss of roughly $4 billion. It is a textbook case of confirmation bias.
The invisible filter. Let's define that precisely.
Confirmation bias is our brain's hardwired tendency to embrace information that supports what we already believe.
And to automatically ignore or filter out anything that challenges it. Our brains are lazy. They want to keep the existing story intact.
And the scary part is that past success makes you more vulnerable to this. When you've been right a lot, you start to dismiss warning signs as just noise.
The stronger your conviction, the more powerful that filter becomes.
And Kim breaks this bias down into 3 parts. The first is selective exposure.
This is where you actively create your own echo chamber.
Exactly. You only read the bullish analysts. You only follow like-minded people on social media. You pre-screen all your information to fit your view.
The second part is biased interpretation.
This is where you and a skeptic can look at the exact same set of facts and see completely different things.
So a company reports lower revenue but higher adjusted earnings.
A neutral observer sees slipping demand. The committed believer sees improving efficiency and margin discipline. Your mind just twists the facts to fit the narrative you already hold.
And the third part, which is maybe the most damaging over time, is selective recall.
Years later, when you think back on that Valeant investment, your memory will actively favor the evidence that supported your thesis. You'll genuinely believe the case was totally one-sided from the start.
So if this is hardwired into us, how do the best investors fight it? They have to build systems.
Systems that institutionalize disagreement. Look at the Buffett-Munger partnership model.
They achieve an edge because they have a culture of consistent, rigorous, and respectful disagreement.
They're constantly challenging each other, not to win an argument, but to find the truth and keep the ego in check.
And then you have the more extreme approach of Bridgewater's radical transparency under Ray Dalio.
Dalio literally built an entire corporate culture around thoughtful disagreement. Feedback is immediate, it's public, and your rank in the hierarchy doesn't protect your idea from scrutiny.
A junior employee is expected to criticize Dalio himself if they think he's wrong.
So the lesson for you, the listener, is that you have to actively seek out opposing views. Force yourself to articulate the 3 strongest arguments against your own investment.
If you can't make a genuine bear case, you're probably suffering from confirmation bias.
And this gets to the crucial distinction between informed conviction and blind conviction. You need conviction to hold on during tough times.
But blind conviction is the danger. That's the filter that confuses stubbornness with strength.
Informed conviction is earned by doing the homework and, most importantly, by actively looking for the evidence that could prove you wrong.
Ackman's failure with Valiant wasn't a failure of intelligence. It was a failure of flexibility.
Which raises a really profound question. If we can filter out solid facts, what happens when our initial premise isn't based on facts at all, but just on a really good story?
Let's talk about when stories trump reality.
The greatest cautionary tale here, without a doubt, is the merger between AOL and Time Warner back in January 2000.
A $165 billion deal, the largest in history at the time. The excitement was just off the charts.
And the pitch, the story, was just irresistible. AOL had the distribution, they were the internet, and Time Warner had the world-class content, HBO, CNN.
The narrative was seamless synergy, a new digital media empire that would own the new millennium.
But reality is stubborn, and it intervened very quickly. First, the cultures clashed immediately. The fast-moving tech startup versus the slow, entrenched old media giant.
And second, the core technical assumption was destroyed almost overnight.
While everyone was mesmerized by the synergy story, high-speed broadband was rolling out, making AOL's dial-up business totally obsolete. The foundation of AOL's value just crumbled away.
And the result was just financial carnage. 3 years later, a $99 billion write-off, the biggest in corporate history.
The story was phenomenal. The execution was a disaster.
This just perfectly exemplifies the seduction of narrative. Stories give us this powerful sense of why that bypasses our rational brain.
They hit us emotionally, they make us feel, not just think, and they give us this illusion of understanding by just glossing over all the uncertainty and randomness of the real world.
And once we accept that tidy narrative, complexity aversion kicks in.
Why do the hard work of valuation when you have this beautiful, simple story about disruption? Then confirmation bias locks you in.
And the modern high-stakes version of this is what you could call the Tesla story machine.
For years, Tesla's valuation was driven far more by the narrative, the story of disruption, AI, Elon Musk's vision, than by traditional financial metrics.
That powerful vision creates this huge emotional buffer.
Right. Production delays, quality control issues, negative cash flow. In any other car company, those would be lethal. But for Tesla, they were just bumps in the road because investors believed in the mission.
The story became the thesis.
So we need to be able to spot the red flags in these corporate narratives. The first kind to watch out for are the disruption stories.
This will change everything, or we're the Uber of X pitches.
They always ignore the messy, high cost of disruption, the retaliation from incumbents, and the sheer luck required. They sell certainty where there's only extreme risk.
Second, turnaround tales. New management will fix everything.
As Peter Lynch said, turnarounds seldom turn. The story always dramatically understates how hard it is to fix deep structural problems.
Third, merger synergy stories. The 1 + 1 will equal 3 narrative.
The data shows most mergers fail to create value. The story glosses over the cultural clashes and the wildly optimistic forecasts.
And we need red flags for these narrative-driven companies themselves.
First, watch for shifting story syndrome. When a company keeps changing its identity to chase the latest trend from cloud-first to AI-driven.
Also, beware of personality cults. When the entire investment thesis is about one visionary CEO.
That's huge key person risk, and it makes objective analysis impossible.
And watch for the missing metrics phenomenon. When management leads with flattering, made-up numbers like adjusted EBITDA while burying the real financials.
They're managing your perception, not their performance.
So the opportunity for the disciplined investor is in what you call the power of anti-narrative.
This is where value is hiding in plain sight, because the story is boring or even negative.
The market misprices the durable, predictable, boring businesses.
Think of a company like W.W. Grainger, an industrial supply company. No sexy story, just consistent free cash flow, because there's no narrative premium baked into the price.
That's a fantastic takeaway. But even when we start with the facts, sometimes a single number can just lock us into an outdated view.
Let's talk about our final bias, getting stuck on your first impression, the anchoring trap.
And the story of Ron Johnson at JCPenney is the perfect corporate example.
Ron Johnson was the retail genius behind the Apple stores. That was the powerful first impression, the anchor.
When he was hired at JCPenney in 2011, the market was euphoric. The stock popped 17% on the news alone.
And Johnson anchored completely to his past success. He scrapped the coupons and sales that JCPenney's customers loved and tried to create a high-end, fixed-price Apple Store vibe.
With disastrous results.
Immediate disaster. The core customers vanished. He failed because he was anchored to a past success in a totally different context. He never asked, what if this isn't the same game?
And this happens to us as investors all the time when a number becomes a ball and chain.
We get fixated on a stock's old high, or, most destructively, our own purchase price.
That purchase price is the classic emotional anchor. The market doesn't care that you paid $50 for a stock that's now at $20.
But that emotional need to get back to even paralyzes people. It makes them hold on to losers forever.
We saw this with investors in Macy's. Their anchor wasn't the deteriorating retail business.
It was the real estate value of its Manhattan flagship store. That one tangible asset served as a mental justification that blinded them to the reality of the business itself.
This bias is also critical in negotiations.
Oh, absolutely. The research is clear. The very first number mentioned in a negotiation acts as the anchor for the entire conversation.
It sets the frame. That's why a high initial listing price on a house can pull the final sale price higher.
And we even see this with round numbers as mental landmarks. Investors subconsciously treat numbers like $10, $50, or $100 as psychological barriers.
Right. They set their buy and sell orders right at or just below those numbers.
And that collective behavior causes prices to stall or bounce around those levels. A smart trader can use that aiming for, say, $99.80 instead of $100.
So how do we break free from these anchors? The book says you need to use multiple yardsticks.
You have to deliberately generate several different reference points. Don't just use a PE ratio.
Use price to sales, discounted cash flow, replacement cost, a whole toolkit.
If the numbers from these different models all point in the same direction, your conviction is informed.
Yeah.
If they're all over the place, you're probably just anchored to the one you like best.
And even more powerful is adopting a zero-based mindset.
This means regularly rebuilding your valuation from scratch, as if you've never seen the stock before.
And the most practical way to do that is the clean slate method.
Just ask yourself one simple question. If I had this position as cash today, would I buy this stock at this price right now?
If the answer is no, you should sell, period. It breaks that emotional attachment to what you originally paid.
That mental agility, the ability to let go of sunk costs and old beliefs, that's the ultimate separator. It requires incredible humility.
This has been an incredible deep dive into Hyun Kim's framework, really laying bare the cognitive landmines that are just waiting for all of us.
We've covered 6 critical behavioral biases today. Brilliance blinds us with the ego trap of Theranos.
Overconfidence, the illusion of control that brought down LTCM.
Mistaking luck for skill. The outcome bias we saw in Bill Miller's famous streak.
Confirmation bias, the invisible filter that cost Bill Ackman billions on Valent.
Narrative bias, where a great story like AOL Time Warner trumps a terrible reality.
And finally, anchoring, the fixation on the past that doomed Ron Johnson's plan for JCPenney.
And the core lesson is just so clear and undeniable. Intellectual intelligence is a distant second to behavioral discipline.
Our ancient brains are just not built for modern markets. And just knowing about these biases isn't enough to protect you?
Not at all. The most valuable skill is self-awareness. Recognizing the traps and then building those non-negotiable guardrails. Your systems, your checklists, your journal.
All designed to counteract your own worst, most costly instincts.
It means accepting randomness, focusing on your process, not the outcome, and having the humility to admit when the facts have changed, even if your feelings haven't.
It all comes back to that amazing quote from Benjamin Graham, the father of value investing.
The investor's chief problem, and even his worst enemy, is likely to be himself. The true edge isn't in predicting the market.
It's in mastering yourself, staying patient, and letting a consistent, grounded process do its quiet work over decades.
And that is something for you to mull over as you build your own investing framework and search for your own behavioral edge.
Thank you for watching, Greya. Please like, Ash, share, subscribe, follow up in next topic.
Come back to continue the psychology of stock market investing. Welcome back, everyone. We are continuing our deep dive into this really critical topic, focusing today not just on the intellectual side of the market, but on the traps, the psychological traps that lock us into losing positions, and more importantly, the practical systems we can build to escape them. If part 1 was kind of the diagnosis, this is the hard-earned prescription.
Indeed. Yeah, in our last discussion, we really dug into overconfidence, the illusion of skill, why so many people mistake luck for genius. But today, we get into the core emotional reflexes that are just so much more destructive. We're talking about the pain of a loss, the intense fear of admitting you're wrong, and that magnetic pull of the crowd.
Right.
These aren't just minor quirks. I mean, they're ancient survival mechanisms that when you trigger them in the modern market, they turn these small, manageable errors into catastrophic wealth-destroying losses.
It's so true. If intelligence were the only factor, every PhD would be a billionaire, right? But it's that messy, predictable human element that creates the violent cycles and the recurring crises we see decade after decade.
Exactly.
So our mission for you today, the learner, is to walk away with not just an intellectual understanding of why we fail, but a full, actionable toolkit. We're going to give you specific strategies, things like the pre-mortem technique, the mechanics of portfolio trenching, to help you build these psychological guardrails. The goal is to become a dramatically more resilient and rational investor. We're moving beyond theory. We're giving you the practical infrastructure you need to keep your behavior aligned with your long-term financial goals, even when the market is just screaming at you to panic.
Let's do it.
Okay, let's unpack the first major bias, one that consistently destroys just vast amounts of capital, both for individuals and, entire corporations. It's the inability to admit we're wrong. This is the failure that behavioral scientists often call commitment escalation. And this is really the precise point where a rational investment thesis, it just fades and the powerful irrational force of ego takes over. It turns what should have been a simple surgical cut and run into an all-out personal war with reality.
Commitment escalation is, at its heart, it's a profound internal conflict. It's that deep-seated human tendency to just double down on a losing effort simply because of what you've already invested, what we call sunk costs. You're not making a purely rational, forward-looking decision based on future prospects anymore.
Right. The money's already gone. Logically, it's irrelevant.
It's irrelevant to tomorrow's value. But emotionally, those costs, they become handcuffs. It's the investor who keeps digging the hole deeper, absolutely convinced that the way out is further down, when the absolute smartest move, the profitable move, is to drop the shovel and start filling the hole back in. It's psychological inertia just completely overgating economic logic.
And when we look for a textbook example of this playing out on the public stage, there is none clearer or more infamous than the Bill Ackman Herbalife saga. This wasn't just a trade. This was a multi-year, multi-billion-dollar psychological and, frankly, reputational war. It perfectly illustrates the danger of confusing an investment thesis with, a personal mission.
That's a powerful distinction, yeah. Back in, I think it was December 2012, Bill Ackman, who's known for his aggressive activist style, he made one of the boldest and most public calls of his career. He declared, and he was very forceful about it, that Herbalife, the global multi-level marketing nutrition company, was not just overvalued, but was, in fact, an illegal pyramid scheme. And he said it was destined to collapse into bankruptcy, sending the stock to zero.
And he didn't just say it. He backed it up with a massive reported $1 billion short bet.
A huge bet. And the initial thesis, it might have been rational. He had detailed research on their sales structure, all of that. But what happened next is a perfect demonstration of commitment escalation.
He didn't just let the position play out quietly. He could have folded when the stock refused to fall, or when it even started to rally against him. But instead, Ackman elevated the stake. He went public. He launched what was basically an evangelistic campaign. We're talking hours-long presentations, funding external investigations, hiring lobbyists, holding these huge press conferences, all designed to actively prove his case and trigger regulatory action.
And that's the problem. The problem with such a public, aggressive stance is that the short bet ceases to be a calculated financial position. It becomes intertwined with your identity and your reputation. And then when the stock held steady and rival activist investor Carl Icahn publicly entered the fray, taking a massive long position directly opposing Ackman.
Oh, that was incredible television.
It was. The conflict turned into this public grudge match, broadcast on live TV. It became personal.
And the losses mounted, the stock proved really resilient, and Ackman just endured this intense public criticism for years. He could have just closed the position, right? Taken the loss, moved on to the next idea, but his personal and professional credibility had become completely staked on Herbalife's demise.
And when he finally admitted defeat and closed the short position in 2018, the financial cost was immense. But the opportunity cost and the reputational cost, the years he spent focusing on this single escalating error were arguably even higher.
That's the key takeaway from the behavioral analysis, isn't it? The book points out Ackman might have even been directionally right in the very, very long term. The stock price did eventually drop significantly years later, but the investing process was fundamentally flawed. The moment that thesis became a public, ego-driven mission, it was broken.
Absolutely. When flexibility vanishes because admitting a mistake feels like a professional defeat, you've just sacrificed rational decision-making at the altar of commitment.
Okay, so let's break down the psychological drivers under that. It starts, as you mentioned, with the sunk cost fallacy.
Exactly. And this fallacy is simple. The mind irrationally believes that because money, time, or energy has already been spent, we have to continue the effort to get our money's worth. If you spend $10,000 on a stock and it falls to $5,000, your brain doesn't just see $5,000 in potential future returns. It sees the $5,000 you wasted.
You want to get that back.
You want to get it back. Rationally, that initial $10,000 is irrecoverable. It's gone. It should be ignored. But the emotional cost is a huge barrier to selling. So we throw good money after bad simply to retroactively justify the initial expense.
And that feeds directly into what you call self-justification and cognitive dissonance.
Yeah.
We're just wired to protect our self-image as, intelligent, competent people. So when the market gives us objective evidence, a collapsing stock price, that our initial thesis was flawed, we experience this intense mental discomfort. That's cognitive dissonance. And to resolve that pain, we don't change our behavior. We change our story.
We invent reasons. The market is too emotional, the analysts are incompetent, or my favorite, this is a 5-year play and I just bought it 6 months ago. These narratives, they allow us to twist the facts until they align perfectly with our belief system. And in doing so, we protect our ego from the intense pain of admitting, I was fundamentally wrong.
It plays out like a predictable psychological pattern, which the material frames as a 3-act drama. Act 1 is the initial commitment, which is usually born from a pretty rational thesis. Act 2 is disconfirmation, where the data starts showing cracks, the thesis wobbles, and the stock price signals trouble. This is the moment of truth.
And unfortunately, most investors default to Act 3, the escalation response. They double down. They often buy more to lower their cost basis, which is just a term investors use to feel better about throwing more money at a problem, or they become intensely emotionally committed to the position just to avoid realizing the failure. And this progression is so insidious because every single act of escalation makes the next act of doubling down feel easier. It slowly transforms a small, measured bet into a large, emotional, and uncontrollable gamble.
Now, you might think this only happens to individual traders or, activist hedge funds, but you mentioned this bias is massive in the corporate world. Let's look at General Electric under Jeff Immelt. How does commitment escalation scale up to a Fortune 5 company?
Oh, GE's decline is a staggering multi-decade case study in corporate escalation. Immelt inherited a really complicated conglomerate. It was heavily burdened by GE Capital, the enormous, complex, and high-risk financial arm created by his predecessor. Confronting that structural risk would have required admitting that the prior strategy of leveraging the balance sheet for growth was deeply flawed, and that admission was just too painful.
So instead, GE management spent years in the escalation response. They just kept focusing on maintaining the image of strength. The material notes these specific devastating decisions, like maintaining these hefty dividend payouts and executing massive stock buybacks, even when the core industrial business just could not produce the cash flow to support those promises.
This is so critical. Between 2015 and 2017 alone, the company returned an estimated $54 billion to shareholders. That's capital it desperately needed for restructuring, for debt reduction, and for investment in its core business. This wasn't strategy. This was a commitment to maintain the illusion of success and continue the previous strategy rather than pivot to reality. The moment they realized they were wrong, they should have cut the dividend and aggressively shrunk GE Capital, but they kept doubling down.
And when they made that huge move into the oil and gas sector right before prices cratered, they didn't pull back. They went further, merging their oil business with Baker Hughes. The narrative kept twisting, simplifying, digitizing, but the fundamental refusal to confront the failing model just persisted.
And this cycle, fueled by the avoidance of sunk costs and the immense pressure of public perception, it culminated in hundreds of billions of lost shareholder value and the eventual humiliating breakup of the company. It perfectly illustrates the public commitment trap. For CEOs and major fund managers, their every move is scrutinized. Selling means admitting I was wrong to the board, to shareholders, to the media. That shame of public failure often reinforces the urge to escalate and save face, even if it guarantees worse financial results.
The pain of admitting failure is just incredibly profound. And that pain links directly to the next massive bias we need to unpack: the deep psychological aversion to losses.
If commitment escalation is the refusal to stop losing, loss aversion is the deep emotional engine that powers that refusal. This is really the cornerstone finding of behavioral economics. The core concept is that losses hurt about twice as much as gains delight.
Twice as much. That's an easy phrase to say, but I want to understand what that actually means on a neurological level for the listener. What is happening inside our heads that makes a loss feel so much worse?
The science is very clear on this, largely thanks to the Nobel Prize-winning work of Daniel Kahneman and Amos Tversky. They established that the emotional disutility of a loss is roughly twice the magnitude of the pleasure you get from an equivalent gain. And the neurobiology, it backs this up. It shows this profound symmetry in how the brain processes these events.
So when we experience a 10% gain in our portfolio, where does that register?
A gain activates the ventral striatum, which is the brain's reward center. It's a pleasant, motivating feeling, a smooth release of dopamine. It feels good. But when we look at losses, the response is entirely different. A loss activates the amygdala and the anterior insula. These are ancient brain structures hardwired for processing fear, disgust, and physical danger. A 10% drop in your portfolio registers, quite literally, as a sudden, intense physical threat to your survival, just as if a predator had appeared.
That distinction explains everything. A 10% drop doesn't just feel bad. It feels like a punch to the gut. It feels like danger. The intensity of that fear response completely overpowers the mild pleasure of a game.
Precisely. And this intense, threat-driven fear is what forces the irrational behavior we see in the market. Look at the institutional investor caught up in the Nikola example from 2020. Nikola was the darling of the EV sector, framed as the next massive growth story, until Hindenburg Research published a damning report alleging massive fraud. It included staging a promotional video of a truck rolling downhill without a working engine, implying it was running under its own power.
The facts were irrefutable. I mean, the company's story was broken, the founder was soon facing charges, and the stock plunged over 40% immediately.
The rational move for any sophisticated investor armed with this information would be to immediately liquidate the position and preserve the remaining capital. Yet this institutional investor, despite vast resources and experience, didn't sell. In fact, they doubled down. They bought more shares.
Why? I mean, if the thesis was destroyed, what could possibly motivate that purchase?
Loss aversion. The pain of realizing the initial loss of clicking sell and locking in that enormous mistake was so psychologically intolerable that the investor chose the desperate gamble of buying more, praying for a slight rebound, just to avoid the awful feeling of realizing that initial loss. It's a refusal to accept the reality that the money is already gone. They're chasing the dream of getting back to break even, which behavioral finance calls riding losers.
And this chasing of break even is what defines the disposition effect, which is one of the most reliable mistakes made by retail investors.
It is. The disposition effect is the tendency to sell your winners too soon and hold your losers too long. We grab the sugar selling the winner locks and that dopamine rush of a realized gain, but we desperately avoid the pain holding. The loser allows us to postpone the painful realization of that loss, keeping it as a paper loss rather than a real psychologically crushing one. This behavior prevents profits from compounding and allows losses to deepen, which is just a continuous self-sabotaging cycle that erodes long-term returns.
And the cost of this emotional tinkering is staggering, especially when we talk about compounding. As Charlie Munger famously warned, the first rule of compounding is to never interrupt it unnecessarily.
Interruptions, driven by this fear and dopamine cycle, are wealth killers. The research material illustrates this with a really stark, tangible example. Two friends, identical starting capital, similar investment profiles. Friend A checks their portfolio daily, reacting to every headline, every 1% swing, and trading often due to emotional interruptions driven by noise. Friend B sets a disciplined plan and checks only quarterly, ignoring the daily fluctuations.
And the outcome after 15 years is shocking. The frequent emotional trader, friend A, has accumulated approximately $480,000. The disciplined investor, friend B, has over $1.2 million.
Think about that. Nearly 3 times the wealth. Not because of superior stock picking, but because of superior behavior. That difference was caused by fewer emotional interruptions, lower transaction costs, and just allowing compounding to work its magic without constantly pulling up the plant to check the roots. Wealth is built through discipline and patience, but loss aversion ensures most people sacrifice that patience for immediate emotional relief.
Loss aversion and the fear of being wrong are internal pillars, but they often combine with this powerful external force, the herd. If the tribe runs from a perceived danger, you run too. That's an ancient, useful survival instinct that now drives speculative manias in the modern market.
Precisely. Herd mentality or social proof tells us that if many people are doing something, it must be safe or correct. In a pre-digital era, this instinct helped early humans survive. In today's market, it drives FOMO, the fear of missing out, which is simply the fear of being the one left behind while everyone else gets rich.
And nothing, nothing, embodies the modern herd mentality and FOMO quite like the GameStop case study of early 2021. This wasn't a standard bubble. It was a psychological phenomenon driven by mass coordination.
It was a fascinating and, frankly, a concerning event. GameStop stock, a struggling brick-and-mortar retailer, was trading around $17 before it just exploded. It eventually rocketed to nearly $500 in a matter of weeks. The rally was driven almost entirely by retail traders coordinating on platforms like Reddit's Wall Street Bets. And it was framed as this populist crusade, David versus Goliath, taking on hedge funds that had placed these large short bets against the company.
So investors jumped in for ideological reasons or just for the adrenaline rush, but primarily due to FOMO. The rapid ascent, plastered across every headline, convinced millions that they had to get in or miss the opportunity of a lifetime.
And that's where the danger lies. When an asset's price is determined by the expectation that the next buyer will pay more, rather than any underlying intrinsic value, it's a speculative mania. The material stresses that many latecomers, those who entered when the stock was already soaring, lost substantial savings when the hype inevitably faded and the stock crashed back down to earth. Their belief that they were part of a powerful, safe crowd made them completely ignore fundamental risk assessment.
How much of this acceleration is due to technology? Because this kind of surge didn't happen 30 years ago.
It's driven by what we call the digital amplifier, the convergence of commission-free trading apps and hyper-efficient social media platforms like Reddit, Twitter, and TikTok. It accelerates herding dramatically. Information, hype, and often outright misinformation, it travels globally in seconds. It creates these high-speed echo chambers where dissenting opinions, often called FUD, fear, uncertainty, and doubt, are instantly marginalized.
And let's not ignore how the apps themselves are specifically engineered to exploit these biases.
They absolutely are. Many popular trading apps use behavioral engineering straight out of the casino playbook. They use bright colors, celebratory confetti animations when a trade executes, and variable reward schedules, much like a slot machine, to turn investing into an impulse-driven, addictive video game experience. The apps profit when you trade frequently, not necessarily when you succeed long-term, so their design ethos encourages exactly the kind of emotional, frequent trading that destroys compounding returns.
The contrarian insight here, which is so difficult to internalize when the market feels, so buoyant, is the paradox of safety.
The crowd feels safest when it is mathematically most dangerous. When everyone agrees on an asset or a sector, it usually means that all the potential upside is already priced in. Think back to the dot-com bubble. The consensus that profits didn't matter and that internet traffic was the only metric that lasted until the day it didn't, and trillions in paper wealth were instantly erased. That consensus was the danger signal.
And this principle even applies to internal professional circles. If your entire newsfeed, your group chat, every conference speaker is bullish on a single theme, say crypto or specific momentum stocks, that internal herding creates an echo chamber that actively suppresses critical thought.
And that leads to the risky shift phenomenon. Groups often take far bigger risks than individuals would alone. They operate under the dangerous assumption that someone else, the smart person in the chat, the fund manager, the consensus, has already thought through the downside. That quest for social proof and agreement often pushes rational risk assessment entirely out of the room, leading to massive synchronized exposure to risk.
Okay, so if fear, loss aversion, and the crowd are pushing us toward emotional action, what dictates the timing of those mistakes? That brings us to our final major bias, the illusion that whatever's happening today must be permanent.
Right. This section addresses the tendency to mistake short-term trends for long-term destiny. The core concept here is recency bias and extrapolation. Our brains prioritize the most recent, most vivid data points. This leads us to believe that the recent past, say, the last 18 months of stunning returns in a certain sector, is a reliable map for the distant future. The logical error is simple. We just straight line the trend and assume it continues indefinitely.
And again, when you couple that simple error with catastrophic leverage, you get a disaster like Archegos Capital Management, led by Bill Swang. This story really shows that sophistication does not immunize you against fundamental behavioral errors.
It doesn't. Not at all. Bill Hwang, already a controversial figure, turned his family office into an estimated $100 billion behemoth through extreme concentration and leverage. His strategy was pure momentum. He focused on riding the stocks that were flying, like Viacom, CBS, and various Chinese tech companies. He wasn't investing in value, he was betting that momentum would continue. He assumed what had been working for the past year, riding winners higher and higher, would continue indefinitely. That was classic, extreme recency bias.
But the mechanism of his leverage needs to be understood because it explains why the collapse is so fast. He wasn't using traditional margin. He was using total return swaps, or TRSs. Basically, synthetic leverage with banks. Explain what that means simply.
Okay, so think of a TRS as a contract where Hwang pays the bank a small fee, and in return, the bank agrees to pay him all the profits if the stock goes up. Or Hwang pays the bank if the stock goes down. Critically, Hwang never technically owned the shares. The banks did. This meant he could build these massive, concentrated positions, sometimes 5 to 8 times the capital he actually possessed, without ever showing up on regulatory disclosures as a major shareholder. This high leverage meant any small tremor in the stock price would create a catastrophic fault line.
And the tremor came when Viacom CBS announced a large stock offering, which effectively signaled to the market that even management thought the price was high. The stock dropped 9% in one day, and then 23% in the next 2 trading sessions.
That seemingly small drop was the fuse. Because Hwang's exposure was so leveraged and so concentrated, the banks holding the actual shares, like Credit Suisse, Nomura, and Goldman Sachs, had to immediately call their margin to protect themselves. Hwang couldn't cover the margin calls. Archegos was financially vaporized in days. The banks were forced to liquidate tens of billions of dollars worth of his stocks onto the open market, causing further collapse and leading to billions in losses for the banks themselves. Hwang's failure was the ultimate outcome of betting the entire farm on simple linear extrapolation, ignoring the historical base rate that teaches us markets are cyclical, violent, and do not move in straight lines.
And this connects directly to the base rate fallacy. We fixate on recent vivid events, which is availability bias, and completely ignore long-term statistical base rates. For instance, the U.S. stock market, historically, experiences a 20% or greater bear market crash roughly every 3.6 years.
But if you're 5 years into a fantastic bull run, your recency bias tells you, keep buying, the market is invincible. But the base rate history says you are overdue for a significant correction. We ignore the historical reality that market leadership rotates from growth to value, from U.S. to emerging markets, and that extraordinary performance is, by mathematical definition, temporary.
We saw this same error play out vividly in corporate strategy during the pandemic with companies like Peloton. Management assumed that the anomalous growth spike was permanent, mistaking a circumstantial windfall for a structural trend.
The pandemic provided a 400% plus growth tailwind for Peloton as gyms shut down and everyone bought home fitness equipment. Management treated the short-term circumstantial peak as the new normal for demand. This led them to aggressively overman production, acquire new facilities, and forecast massive perpetual growth. When demand normalized as the world reopened, they were left with warehouses full of unsold inventory and inflated operational costs.
The result? A 90% plus stock crash from its high. They extrapolated a temporary peak into a permanent trend, ignoring the base rate of historical consumer demand cycles.
And the market itself suffers from this collective memory problem. Consider the famous debate around inflation in 2021. For years, inflation had been low, so when it spiked due to pandemic-related supply shocks, the consensus among many experts was that it was transitory. Why? Because their most recent, most available data set was the last 20 years of low inflation. They ignored the painful history of the 1970s, where inflation became sticky and structural.
This also fueled the TINA consensus, there is no alternative, which grew after the 2008 financial crisis, built on the assumption that interest rates would stay near zero forever.
That assumption was the definition of recency bias on a macro scale. Entire investment strategies, particularly in private equity and high-growth tech, were built around the certainty of cheap money. When the cycle inevitably shifted in 2022 and rates began to climb rapidly, portfolios built on that single linear assumption struggled immensely. It proved that the base rate that cycles always turn is immutable.
So if we are analyzing a company's management team for an investment, what is the recency bias red flag we should look out for?
Always watch for management that draws straight lines from recent success. If they treat a short-term, high-margin windfall like a spike during a supply chain disruption as a permanent improvement in profitability, be wary. Look for those who consistently blame external forces, the economy, the Fed, global events, when the cycle inevitably shifts, rather than acknowledging the cyclical nature of their own industry. We should look for the humility and realism demonstrated by long-term thinkers like Buffett, who plan for the worst-case scenario regardless of how good the recent quarter was.
Okay. We spent enough time diagnosing the illnesses, commitment escalation, loss aversion, herding, recency bias. Now we move to the solution. Knowing the biases isn't enough, we need systems and structured behavior. This is where we dive into the practical toolkit for building psychological guardrails and achieving Charlie Munger's goal of being consistently not stupid.
The shift is fundamental, yeah. We start trying to be fortune tellers, and we start focusing entirely on being rigorous risk managers. The tools are designed to force clear thinking when your emotions are running hot. We'll organize these tools into 3 buckets: mental preparation, decision review, and portfolio mechanics.
Let's start with mental preparation, which is all about planning for failure before the fact. The first and perhaps most powerful technique is the pre-mortem.
The pre-mortem technique, championed by researchers like Gary Klein and Daniel Kahneman, is just brilliantly simple. Before you commit to an investment, before you buy the stock, you imagine that the investment has failed catastrophically a year from now. Say it's down 30%, or the company is facing bankruptcy. You then work backward, listing all the plausible reasons why it failed.
This is a sneaky way to overcome confirmation bias, isn't it? When we're excited about an investment, our brain only seeks data that confirms our thesis. The pre-mortem forces you to proactively seek out the potential threats and blind spots you might have ignored.
That's its core strength. It legitimizes doubt before your ego is fully committed, and you're forced to articulate the bear case while you're still capable of thinking rationally. If you can't generate a convincing list of failure reasons, you might be overconfident.
The second tool for disciplined thinking is the decision journal. This seems simple, but its power is profound.
It is the single most important tool for self-awareness. It's an honest, unedited record of your investment thesis, your calculation of risks, your confidence level score at 1 to 10, and your current feelings before you execute the trade. Gurus like Guy Spire and James Montier stress this. When you look back later, you judge the quality of your original rationale, not the convenient story you tell yourself after the fact.
And that combats the insidious hindsight bias. We tend to look at an outcome and say, oh, I knew that was going to happen. The journal proves whether or not you actually did.
Exactly. Next, you have to cultivate the habit of active disconfirmation. This is the conscious effort to seek out the smartest people and the most compelling arguments that disagree with your thesis. Ray Dalio calls this thoughtful disagreement. You must put real effort into finding the best bear case or the smartest analyst who is shorting the stock.
The Munger and Buffett partnership works on this principle. They challenge each other to find the truth, not just to win arguments. It's about building a culture of intellectual humility where dissent is a feature, not a flaw to be suppressed by an echo chamber.
And finally, under mental preparation, we have the clean slate method. This is your weapon against the sunk cost fallacy and anchoring bias.
Tell us how to implement this.
Every few months, or whenever you're considering doubling down on a loser, you must ask yourself the ultimate question. If I didn't already own this stock, would I buy it today at this current price? This question breaks the emotional and financial anchor of your original cost basis. The market doesn't care what you paid. The only thing that matters is the current valuation based on current realities. If the answer is no, the rational move is to sell, regardless of how much money you've already lost. This is what the leadership at GE failed to do for years.
That brings us to our second bucket, process accountability. This is about making sure that the quality of your thinking is the priority, regardless of whether you make money tomorrow or not.
We begin with the process outcome matrix developed by Michael Mauboussin. This framework forces you to separate the quality of the decision-making process from the eventual result. Did you have a good process that led to a bad result? That's bad luck. Or did you have a bad process that led to a good result? That's just dumb luck.
And the insight here is crucial. You can never learn from luck. You can only learn by rigorously improving your process.
Precisely. And good process often starts with a checklist, which Munger and Seth Klarman both advocate. A comprehensive, disciplined checklist covering valuation, management quality, financial stability, market structure. It ensures you avoid critical errors of omission, especially when you are rushed, stressed, or overly confident. It forces you to cover your bases.
And to fight the lure of certainty, we need probabilistic thinking.
Stop thinking in certainties. The future is a range of possibilities, not a single fixed outcome. You have to define a range of outcomes, base case, best case, worst case, and assign rough probabilities that sum to 100%. If you think a stock has a 70% chance of going up 20% and a 30% chance of going down 50%, you can manage that risk far better than if you are simply 100% convinced it's going to the moon.
Howard Marks calls this a shift from certainty to probabilities, noting it's one of the greatest superpowers an investor can possess. It replaces tidy, overly confident narratives with the messy reality of risk.
Our final and most crucial bucket is portfolio mechanics, structuring your capital so that your physical actions override your emotional impulses.
Let's start with a defense against that emotional tinkering: portfolio tranching.
Portfolio tranching is basically using mental accounting to your advantage in a constructive way. You structurally divide your capital into distinct buckets. For example, a low-risk, long-term core, say 70% in low-cost index funds, a strategic bucket, and a small, high-conviction or tactical speculative bucket, maybe no more than 5 or 10%. This serves two immediate purposes. First, it shields your core wealth from loss aversion. Second, that small speculative slice satisfies the itch to act without jeopardizing your long-term financial foundation.
And to fight the daily noise and the intensity of loss aversion, we need the check-in calendar.
You must enforce rigid, scheduled review dates, maybe quarterly, maybe monthly, and absolutely avoid checking investments or reading financial news about your specific hoardings in between. Research by Benartzi and Thaler shows that frequent evaluation leads to excessive sensitivity to short-term losses, which directly prompts the bad decisions we've been talking about. A strict calendar dramatically reduces loss aversion and recency bias caused by frequent emotional exposure to noise.
To enforce a systematic buy low, sell high approach, we rely on mechanical discipline, regular rebalancing.
Set a target allocation. For example, 60% stocks and 40% bonds. And at fixed predetermined intervals, annually or semi-annually, you automatically buy what's lagged and sell what's soared to return to your target. This is a mechanical, forced contrarian action that counters both recency bias by selling the recent winners that make you feel smart and herd mentality by buying the asset class the crowd has recently discarded. You literally automate the purchase of what feels bad and the sale of what feels good.
While rebalancing handles general volatility, the contrarian calendar is the system for automating bravery during a full-blown crisis, when panic is at its highest.
This is pre-commitment to action. You write down exactly what you will do when the market hits specific stress points. For example, I will invest 25% of my dry powder if the S&P 500 drops 10%. I will invest the next 25% if it hits a 20% drop. This automates bravery and counters that panic-driven paralysis. It makes sure you execute the plan you made when your head was clear, rather than succumbing to the herd when prices are detaching from reality.
And to make the contrarian calendar possible, we need the dry powder discipline.
You must always hold cash specifically reserved for crises, well beyond your normal operating budget. This cash Buffett's massive war chest at Berkshire is the ultimate example, is not dead money. It is optionality. It transforms a crisis where everyone else is frozen by fear into a shopping opportunity, allowing you to strike when the best companies are suddenly on sale at ridiculous prices.
And finally, the structural framework for risk management, which helps dampen fear and loss aversion up front, is the Don-Ho framework.
Championed by Monish Pabrai, this Indian framework means endeavors that create wealth. It's structuring investments for the specific outcome. Heads, I win big. Tails, I don't lose much. You prioritize avoiding permanent capital loss, which is Buffett's rule number 1, by focusing your analysis primarily on the worst-case scenario. If you can define the downside as small, survivable, and temporary, the upside potential, once you analyze it, will take care of itself. This discipline ensures you manage risk first and return second.
That was an incredible amount of insight. We've covered how commitment escalation, the intensity of loss aversion, the magnetic pull of herding, and the base rate blind spot secretly sabotage our wealth. We've really established that the single greatest threat to our financial future isn't the complex mechanics of the market, but our own evolutionary wiring. It's the parts of our brain built for reacting to saber-toothed cats, not for interpreting complex spreadsheets and long-term data.
Your greatest edge in the market is not finding the next great stock or having access to faster data than the institutions. It's mastering your temperament. You cannot eliminate emotion. These biases are baked into human nature. But you can and you must build systems, the journals, the premortems, the tranching, the calendars, that work even when your instincts are screaming at you to panic or to get greedy. The best investors aren't the smartest. They are simply the most disciplined and the most self-aware, and they stick rigidly to their process.
We talked about Charlie Munger's incredibly humbling idea that it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. As you finish this deep dive, consider which one tool, the premortem, the decision journal, or the check-in calendar, you will implement this week to close the dangerous gap between your knowledge and your actual investment behavior.
That gap between knowledge and behavior is where wealth is won or lost. Focus ruthlessly on the quality of your process, not the short-term outcomes. And remember that clear thinking, done consistently over decades, is the most valuable and durable edge you can possibly possess.
This deep dive was based on Hyun Kim's work, The Psychology of Stock Market Investing, Mastering Emotions and Behavioral Biases to Build Wealth. For more on how to build resilience and implement these systems, you can look for the full guide. Thank you for coming along on this deep dive.
Thank you for watching. Please like, share, subscribe, follow up in next chapter.